Now, so far in the series, we have talked about supply, how much the new debt the market has to swallow, and on what terms. That is one half of the ledger. The other half is simpler and closer to home. When government borrowing gets more expensive, who actually feels it? Economists call it the incidence, which is just a formal word for who ends up carrying the cost. The bond buyback debate keeps everyone staring at a single number, the interest rate on long-term government bonds, and quietly ignores the two things that really decide the winners and the losers. First, the authorities are making short-term money cheaper even while the long-term money gets dearer. And secondly, the interest bills on all this debt lands very unevenly across ordinary households. Both are hiding in plain sight. Hello everyone, welcome back to our channel and welcome back to another episode of the Capital Insights series. This series sits within our Fundamental Suganori series, and today here at Punjab Capital Research, we wanted to share with you the mechanics of the hidden bill, who really pays when the government debt increases. And we're not talking about just one government, we're talking about the world governments out here and the real bond situation that is happening, which we have been tracking through a lot of issues that we have shared with you previously. In this issue, let's do a deep dive and let's try and understand who really is paying the premium. Earlier in this series, we have described a quiet but an important flip. Investors used to accept lower returns just for the comfort of holding government bonds. Safety was worth paying for. Now they demand extra returns simply to soak up the flood of new debt that is being issued. We have called that extra charge the absorption premium. When government steps in to buy back its own bonds, it can push the headline interest rate down for a day, but it does not really move the charge. In today's follow-up issue, let's ask and answer a very important question, something that we have skipped in the series so far, and that is, there is an extra charge that we are seeing. There is an absorption premium. So who earns that premium and who pays for it? Who's on each side of the equation? Let's do a deep dive into the half of the story that we have skipped so far. Now, so far in the series, we have talked about supply, how much the new debt the market has to swallow, and on what terms. That is one half of the ledger. The other half is simpler and closer to home. When government borrowing gets more expensive, who actually feels it? Economists call it the incidence, which is just a formal word for who ends up carrying the cost. The bond buyback debate keeps everyone staring at a single number, the interest rate on long-term government bonds, and quietly ignores the two things that really decide the winners and the losers. First, the authorities are making short-term money cheaper even while the long-term money gets dearer. And secondly, the interest bills on all this debt lands very unevenly across ordinary households. Both are hiding in plain sight. Let's talk about the quiet easing that you weren't meant to notice. Now picture the bond market as having two ends. There is a short end, money lent for a shorter time, and a long end, money lent for many years, the way that a mortgage is. The strain has been showing up at the long end, and officials say that they want to leave it alone so that it sends an honest signal about the state of the finances. At the short end, though, they have quietly been plumping money in through a program that they describe as routine maintenance, a technical fix, rather than deliberate policy. Now, there's a simple test that gives the game away. If the banks had genuinely been short of cash, the new money would have sat still doing nothing. It did not. Bank deposits and lending jumped well above their normal pace. Money that gets spent and lent back out isn't plumbing, it's stimulus wearing a quieter name. And that creates a contradiction at the heart of the whole exercise. One hand keeps the long end honest so that it can warn about the rise in prices, while the other hand floods the short end with cheap money that pushes those very prices up. And this brings us to the two ends of the market, two very different crowds. Cheap short money flatters those who borrow for the short term, or those who own a lot of shares and other financial assets. Their funding is cheap, their asset prices are supported, and they carry a quiet confidence that someone will step in if the markets stumble. Expensive, long money is paid by everyone who has to borrow for the long haul. The family taking out a mortgage, the company issuing long-term debt, and the government itself as it rolls over its enormous pile of borrowing. The important thing to note out here is that these are not the same people. The help and the hit fall in opposite crowds. And the buyback, which only nudges the one headline number, leaves the divide exactly where it was. And this brings us to the crux of this issue. Follow the interest and you'll find who pays. When the government debt falls more, the money doesn't disappear into thin air, it gets paid out to whoever owns the bonds. And the ownership of those bonds, whether held directly or tucked inside pensions and saving products, sits mostly with the wealthier households, the ones who actually have savings to lend. The higher borrowing costs, meanwhile, land on everyone else, the household whose lives run on borrowing rather than lending. So, a world of higher interest rate quietly moves money in one direction. Interest income flows up to the people who already own, higher costs go down to the people who owe. It behaves a lot like inflation, a broad, almost invisible charge that presses hardest on the ordinary households. Add up the whole economy, and it looks like a wash. One person's cost is another person's income, but at the kitchen table, it's nothing like even. And the cheap money at the short end trick makes it worse because it channels money into shares and financial assets, which the wealthy own rather than into the real economy. The factories, wages, and productive investment that actually lift everyone's standard of living. The top of the ladder is propped up, the bottom of the ladder fails the charge twice. Let's wrap up with why fixing it quietly makes it worse. Now, this is the part that matters most. Every time officials buy bonds to force the long term rate down, they don't move the extra charge, they just hide it for now and push the reckoning down the road. Meanwhile, the cheap money that they use to hold the whole arrangement together feeds inflation, which makes the charge bigger later on. So the rescue lands on ordinary households twice. It props up the asset owners today and it strokes the prices that hit borrowers tomorrow. And there is the trap in it too. Once you start propping up the market, it becomes very hard to stop. Investors begin to expect the rescue, and you have effectively promised a bailout that you really cannot walk back. So, what's the house view here at Punjab Capital? The absorption premium isn't going away, it is being shuffled around, made cheap at the short end for people who own the assets, charged at the long end for the people who borrow, and pushed down the road to ordinary households who meet it later as higher prices. Intervention changes who pays and when, not whether anyone pays at all. For the investors and the allocators, that points to plain confusion. You want to be the one collecting the charge, not paying for it. That means leaning towards short-term lending wherein you are paid to wait and away from the long-term bonds that lose value as the rates climb. And where the choice is between the paper wealth and real things, it favors real assets. The same shift towards hard assets like gold that our series has been tracking, seen here from the other side of the ledger. That's all that we wanted to share with you in this follow-up video. Stay tuned for our next one.